So for those of you that are in our Discord and want to go have a look, this is the trade ID 3077. Let me just open this up so I can tell you exactly. This trade was initiated by a sale of a put, which was cash secured. Oh, I sold 5. Um, and I was looking to get assigned, and my goal was once assigned, I wanted to sell another put and a call, which is a strangle, right? So it's a covered strangle. My short call is covered by the long shares, and then another put, right? The put, which is part of the strangle, is also cash secured. I was looking to buy more shares at a lower price. I got assigned on the 27th, 500 shares, and then I sold another strangle. So the trade 3077, if you go on there, every single step that was part of this trade up until this point is in the thread. You can kind of piece it together and get a better idea about what is happening. So this was the trade. This is what it looks like before today's adjustment. Today I added another strangle to it. And I want to explain why and what's happening here. So this is the trade before today's adjustment, right? So my position is 500 shares of TLT. I did adjust cost basis for the options that I sold in the previous round. Plus, we got paid on the dividend this week, right? So cost base for the 500 shares has been adjusted, and then I am short a February 21st 84.90 strangle, and the premium I have collected for this strangle has not been adjusted for the cost of these long shares. If and when this strangle expires, if it expires out of the money, the cost will be adjusted. If I get called away, then I will need to adjust the cost or the price of shares getting called away when I log in that adjustment. So up until this point, I'm long 500 shares and I'm short a strangle. Now, with the price of TLT was very close to 90, right? I have a feeling that, if we consolidate maybe for a couple of days, maybe a week, and we continue higher, again, I'm not going to speculate, but if we continue higher and we cross over 90, I'm not going to automatically get exercised and stock isn't going to get taken away from me. But if we do end up with TLT higher than 90 at expiration, which is only 14 days away now, right? This short call is going to be exercised and the 500 shares is going to be called away, which is fine. They get called away. My cost basis on these shares is somewhere around the 86 and change, right? So there will be a capital gain on the shares plus the dividend that we had collected. So to prepare for that, right, I went ahead and in the February 28th with 21 days, right, this is kind of replacing the shares. I went ahead and I sold an 88 put, which is closer, right? I'm willing to buy. If I get called away on the 500 shares, I'm going to replace these shares with the shares that I'm willing to buy at 88 if TLT is going to fall under 88 over the next 21 days. Right? So it's kind of like it hasn't happened yet and there's a lot of moving parts and I'm just preparing for if I get called out of my 500 shares, this put here is cash secured and I'm willing to buy back these shares at 88. So maybe, right, kind of in the perfect world, TLT goes above 90, these shares get called away, and the following week it falls below 88 and I get assigned again. And if none of that happens, right, then this short strangle in the February 21st expiration cycle expires worthless, which will further reduce cost basis of my 500 shares of TLT. And then I'm still willing to buy another 500 shares at 88. And if that is the case, I will end up with 1,000 shares of TLT. And then I'm going to do is I'm going to sell another covered strangle around it, short calls, and another short put. Right. So there's a lot of ifs and thens and all this other stuff. But for right now, my move was to sell an 88 put and a 92 call. And this 92 call, right, it shouldn't, sorry, -5. This short call at 92 should not get exercised. So I'm not really at risk of getting exercised or assigned on this short call, right? Because there is nothing but extrinsic value. Like it just doesn't make sense for anybody. I mean, it could happen, but it's a very low probability that it gets exercised, right? Because why would anybody want to exercise this call and get long shares at 92 when the stock is trading at 89? Right? So I'm selling these 5 calls assuming that I have shares after the February 21 expiration passes. What happens if in the next couple of weeks or in the next 2 weeks, right, by this expiration, we're at 95 or at 94, right? If we're at 94, I have 2 short sets of calls, right? I'm short calls at 90, short calls at 92, but I only have 500 shares. Now so obviously I'm going to collect most of this premium from the 88 put. I may need to sell another put much closer at the money or flat out just buy the stock and deliver the shares if that is the case. In the meantime, right, if nothing happens, if we're just trading somewhere between 89, again, from 89 to 92 or to 94, it sounds like, can it happen? Yes, right? But these are pretty big moves. So I don't think that it's very likely that it's going to happen. But if it does, I'm ready to, figure out my next move. And I don't think that there is a chance that the real big problem in this trade is if TLT goes like over 105 or 110 over the next couple of weeks, which is, I don't really see any reason why that would happen. Can it happen? Yes, but it's very unlikely. So while we're just kind of trading in this range, we could move things around and add calls and puts and maybe roll them out as long as we're collecting a net credit on the rollout. It's totally fine. The goal is to create like this tent, whatever the shape of that tent is going to be. As long as we're inside of that tent, we have positive theta, which means that as time goes, these options are losing value over time, and it's working in our favor. So that's the TLT trade. I think it's pretty simple. This is what the adjusted risk graph looks like. Right, so long 500 shares and short 2 sets of an out of the money strangle.